In our previous video, we talked about the benefits of adding private market investments into your portfolio. Today, we're going to focus on two of the largest asset classes within this space: private equity and private debt. Private equity is like public equity in that your investment represents an equity ownership position in the company. Private equity simply allows you to invest in private companies that are not publicly traded on an exchange. As illustrated in this chart, at the end of 2021, there were over 21,000 private equity-backed companies in North America and Europe, compared to only 13,000 publicly traded companies.
As you can see from this chart, private equity investments have outperformed publicly traded stocks over the past 15 years. In fact, the overall performance in private equity is roughly double the performance of publicly traded stocks. Over this period, not only has private equity outperformed the public markets by a large margin, but it has also done so with much less volatility and lower declines in the negative markets like 2008 and 2022.
We have discussed the difference between public versus private equity, so let's now shift to the debt side. In the public markets, debt generally comes in the form of bonds, which include corporate bonds, government and agency bonds, and municipal bonds. Much like private equity, private debt is generally not accessible through the public markets. Private debt has several characteristics that distinguish it from public debt. First, private debt is often issued with floating rates versus fixed rates for most public bonds. This means when market interest rates change, the rate charged to the borrower will increase and decrease with these changes. In a year like 2022, when rates increased dramatically due to the Fed raising interest rates, much of the public debt had price declines in the double digits. However, in most of 2022, the private debt managers produced positive rates of return as they were able to pass the increase in rates to their borrowers. So not only were they able to increase the income earned, but they also did not experience the decline in value seen in the public markets.
Additionally, private debt generally has much more restrictive covenants than public debt, giving it greater protection and more flexibility and control if there are credit issues. Finally, most private debt is also senior on the capital structure and secured. This means that if there are credit issues with the borrower, the private debt holders are the first ones to get paid and can take assets if necessary. In the public markets, most bonds are subordinated to secure and senior lenders, and therefore have greater risk if or when things go bad.
Private debt has produced higher returns than public debt, and yet done so with lower volatility, as evidenced in this chart. Private debt has produced an average annualized income of 9.7% since the fourth quarter of 2015, which is significantly higher than the low single-digit returns that has been produced by public debt. If you're interested in learning more about how private equity and private debt investments could enhance your portfolio, we would love to have a conversation with you. As always, we appreciate you watching this video and hope that you found it informative.